Financial fitness, 7 fundamentals of financial literacy. Number one, managing your finances. Number two, mapping out your priorities. Number three, minimizing your taxes. Number four, multiplying your income. Number five, maximizing your credit score. Number six, maneuvering your retirement planning. And number seven, maintaining healthy boundaries. Now, before we move forward, let me make this legal disclaimer. The information provided in this seminar is solely for general educational purposes only. Please do not consider any of this information to be specific financial, legal, or tax advice. Please do your own research and consult with your CPA, your attorney, or your tax professional before making any decisions. Number one is managing your finances. The first step is to create and maintain a spending plan, also known as a budget, also known as a list of your inflows and outflows. This is very important because a budget is telling your money where to go instead of wondering where it went, right? And what you want to do, you want to track every penny because tracking promotes awareness, and awareness gives you the ability to identify where you need to make changes. And so right here is an example of a zero-based budget. And basically all you're going to do is just list out all of your expected inflows, right? Money coming in, right? And also list out all of your expected outflows, right? Money coming out. And you're gonna, list them out, and then you're gonna put your expected numbers, right? Your budgeted numbers, right? And then during the month, you're going to be tracking everything, track every penny. And at the end of the month, you want to calculate your actual totals and compare your actual totals to your budgeted totals, right? To your expected totals. So that is a zero-based budget. Very important to have a budget. So that's step one. Now, number two is mapping out your priorities. Mapping out your priorities. This is a framework of financial priorities. Now, each person may have a slightly different framework, but every framework is generally the same, right? Number one, I recommend that you prioritize giving. So that's why in my framework, I make that number one, give. I really believe that it is so very important to prioritize giving because when you give to others from a sincere heart of gratitude, you are confirming to yourself that you have an abundance. And that abundance mindset helps you to achieve even more. Number two, prioritize building up a $1,000 mini emergency fund. $1,000. It's like a baby emergency fund, as Dave Ramsey would say, right? A baby emergency fund, right? A mini emergency fund. Most people live paycheck to paycheck, right? And so I want I want to encourage you to prioritize building up a $1,000 mini emergency fund, right? Later on, we'll come back and we will expand that mini emergency fund to be a full emergency fund of at least 3 to 6 months of your living expenses. But for right now, prioritize building up $1,000 as a mini emergency fund. Number three, pay off all, really, you want to pay off all debt, but especially the high interest debt. Prioritize paying off the high interest debt. And when I say high interest debt, I mean any debt that with an interest rate above 8%. All right. Any interest rate, any debt with an interest rate above 8%, you want to really prioritize getting that paid off. Number four, employer-sponsored retirement funds, right? But only up to the match. So here's the thing about this. These employer-sponsored retirement funds, many of them, not all of them, but many of them offer a matching contribution, right? So they might say, hey, for every dollar that you put in up to maybe like 3% or 4% or 5% of your pay, right? For every dollar you put in up to a certain percentage, we will match you dollar for dollar. Or maybe they will match you, dollar for dollar for the first 3%, and then for the next 2%, they might match you 50 cents per each dollar, whatever. But anyway, the point is this: if you have a regular job, right, and your employer is offering you some type of employer sponsored retirement fund that matches, make sure you take advantage of that match, right? Because that's free money. That's free money. So make sure you take advantage of that if they are matching, right? Now, if they are not matching, I would recommend that you not participate, because I have found that a lot of those employer sponsored retirement funds, there's a lot of hidden fees, a lot of administrative costs to them. And so, unless they are giving you free money to participate, you should not participate at all. All right. So, that's why I say participate, but only up to the match if they're matching. And if they're not matching, then don't participate. Right. All right. Number 5, expand your emergency fund to be 6 months of your living expenses. And now the best place to put it, right? The best place to put your emergency fund is into a high yield savings account or a money market account, right? Because see, a high yield savings account is a savings account that pays higher interest than a regular savings account. Like a very typical savings account only pays like less than 1% of interest, APR, right? But a high yield savings account, many of these high yield savings accounts are paying over 4% right now, right? For example, Capital One Bank has a high yield savings account that pays over 4% APR. So you want to put your emergency money into a high yield savings account, right? Or a money market account. Do your research, find out what would be the best fit, compare the interest rates, and pick. But I highly recommend looking into putting your emergency fund money into a high yield savings account. Number 6, auto invest into a Roth IRA stock index fund. All right. And a little bit later, I'm going to go into detail what that is. It's a retirement fund, and it's very powerful, very, very powerful. Right. So you want to auto invest into a Roth IRA stock index fund. Next thing is auto invest into a non-retirement stock index fund. All right. I'll explain what index funds are a little bit later. Next one, build multiple streams of income through entrepreneurship. You see, every hobby is a potential stream of income. Every hobby is a potential business. And so you want to think about what are the things that you're passionate about, and think about ways in which you can turn those hobbies into businesses. As my friend Michelle often says, turn your passions into profits. And the next one, build multiple streams of passive income through business ownership, stock market investing, and real estate investing. Passive income is so great because with passive income, you put in the work up front, but once it's established, then there's no need for any significant additional work other than just tracking and managing the stream. The stream will automatically continue to bring you income without any type of significant additional work. Now, before we move on, let me explain this. It's very important that you understand what this is. The 7 types of income streams. It's very important that you understand these 7 types of income streams. So, and this is important because your financial goal, right? Your financial goal should be to build your passive income to a level where it exceeds your cost of living. Because when your passive income exceeds your cost of living, that is when you have achieved financial freedom. And so it's very important to understand these 7 types of income streams. First one we're going to talk about is W-2 income. This is the one that everybody knows about, right? Because this is income from work that you do as an employee. This type of income is active income, which means you are trading your time for money. And this type of income is also the most heavily taxed income. Second type, business income. This is income from operating a business. The advantage regarding this type of income is that the IRS allows business owners to take a wide range of tax deductions that lower taxable income because the tax code is designed to benefit business owners and investors. And so if you're working in the business, it is active income because you're trading your time for money. But if you are hiring people to work in the business for you, it becomes more passive in nature, which means your money, your asset, right, is making money for you. Although, of course, you still have to oversee it. The next one is interest income. This type of income is passive in nature. Technically, it's considered to be portfolio income, but for all purposes, I mean, for the sake of our discussion, we can consider it to be passive income, right? And examples include like interest that you earn off of a high yield savings account, also private money lending, right? Like if you're lending money to house flippers, right? And receiving interest, right? So that's interest income. Next one is dividend income. This is income from distributions to shareholders. This type is passive in nature. A great example of dividend income is like from the like dividends that you're paid through like stocks, right? Next one is capital gains. This is income from the increase in the value of assets, such as mutual funds, real estate, etc. It's passive in nature. Next one is rental income. This is income from the rental of assets, such as real estate, cars, equipment, etc. Depending on how involved you are, it can be very passive in nature, right? You can have a rental property and you can get a property manager to manage it for you so that it's the income is more passive, right? And then the last one is royalty income. This is income from selling the rights to use an asset, such as intellectual property. Examples include books, online courses, and YouTube channel monetization. It's very passive in nature. It's very passive. It's passive income. Although a lot of upfront work is usually required, but once it's established, no additional significant work is needed. So those are the 7 types of income streams. Very important. Now, let's talk about another very important topic, and that is how to legally minimize your income taxes. This is very important because for most people, taxes are the biggest living expense, but not for wealthy people. Wealthy people have mastered the skill of minimizing their income taxes through wise planning. And as a side note, a poor mindset plans only for the weekend, but a wealthy mindset plans for multiple generations. One of the major keys to building financial wealth is learning how to minimize your taxes. Let me give you some tips. Number one is this: to minimize your taxes, number one is understand how taxes are calculated. You see, the tax brackets are not based on your total income. The tax brackets are based on your taxable income. And so if you're able to decrease your taxable income, regardless of what your total income is, the key is to decrease your taxable income. And over here, you'll see the 2023 federal tax brackets for single filing status. So do you see how these are the tax brackets and these are the tax rates, right? So now note something here. Like for example, let's take this example. Let's say that a person has $50,000 of taxable income, right? So $50,000. Now, that does not mean that all 50,000 is going to be taxed at this 22% tax rate, right? Because you see, it's a progressive tax system, which means it's split up, right? So for example, if we take this example of $50,000 of taxable income, well, the first 11,000, right, will be in this first tax bracket. And so that first 11,000 of the 50,000 will be taxed at 10%. You see that? Okay. And then right now and then the next 33,725 will be in this second tax bracket. And that amount will be taxed at 12%, right? And then the amount that you have left over, which is 16,275, will be in this third tax bracket. And so that amount would be taxed at 22%. So you see how it's a progressive tax system, right? So for this example of $50,000 of taxable income, well, 11,000 is taxed at 10%, 33,725 is taxed at 12%, and 16,275 is taxed at 22%. You see? That's how the taxes work, right? So the key, the key to minimizing your income taxes is minimizing your taxable income because the tax brackets are based on your taxable income. And so now here's the key question. How can I minimize my taxable income? Well, number two right here, we're talking about taking advantage of section 162A of the IRS tax code, because section 162A of the IRS tax code allows a deduction for all ordinary and necessary expenses paid or incurred during the taxable year in carrying on any trade or business. So what that means is the moment you start a business, it could be a side hustle, it could be you can have the business like as just a little small side hustle, or you can go into full time and be a full time entrepreneur. It doesn't matter. But the moment you start a business, no matter how big or small the business is, the moment you start a business, you open yourself up to being able to take advantage of section 162A of the IRS code, right? And so basically you're able, when you have a business, right, you're able to take advantage of business deductions, right? Examples include advertising expenses, car expenses, contract labor expenses, legal and professional services expenses, supplies expenses, travel expenses, home office expenses, cell phone expenses, training expenses, and the list goes on and on and on, right? Basically, section 162A of the IRS code is saying this: when you have a business, any expense that's related to you operating your business is a tax deduction. That's basically what the rule is, right? So the moment you start a business, a portion of your personal expenses can be reclassified as business expenses. For example, a portion of your car expenses can be reclassified as a business expense. A portion of your housing expenses can be reclassified as a business expense. Even if you're renting an apartment, if you have a business, a portion of that rent, a portion of that housing cost that's related to your business can be deducted as a business expense. Now, of course, there's rules and everything, right? To this, but yes, it can be done. It can be done. A portion of your vacations, if you go on a vacation but you have a business purpose for the vacation, then a portion of your vacation can be written off. A portion of your cell phone expense, a portion of your equipment costs, like computers and stuff, right? A portion, and like if you take any courses that are related to your business, that's a write-off as well, right? So it's amazing. So section 162A, this is one of the main ways in which the tax code is designed to benefit business owners, all these write-offs that we can take. Now, number three is understanding and taking advantage of long-term capital gains, because long-term capital gains are taxed at a much lower tax rate than short-term capital gains, as well as uh, ordinary income, right? Long-term capital gains are taxed at a much lower tax rate than ordinary income. So it's better to have long-term capital gains than to have ordinary income, because long-term capital gains are taxed at a much lower tax rate. In fact, here it is right over here. This here is the 2023 long-term capital gains tax brackets for single filing status. So do you see how if your taxable income is, below 44,625, then you don't have to pay any long-term capital gains tax. Do you see that? If your taxable income falls between 44,625 all the way up to $492,300, then the long-term capital gains tax rate is 15%. If it's above 492,301, then it's 20%. This is so much lower than this up here. These tax brackets for the ordinary income, So it's amazing how the IRS tax code really favors, right, long-term capital gains, because it's in the law that the long-term capital gains, the tax rates are much lower, right? Now, keep in mind, it's for long-term capital gains. If you have short-term capital gains, your short-term capital gains will be taxed at your ordinary income. Short-term capital gains are taxed as ordinary income, but it's the long-term capital gains where you get a huge tax break. So that's number three. Number four is retirement accounts. Retirement accounts. We're going to be talking soon about the Roth IRA, but there's a lot of different types of retirement accounts, and you can take advantage depending on your situation, right? And you can take advantage of retirement accounts to lower your taxable income. Number five is HSAs. This is health savings accounts, right? Health savings accounts. This is really cool because it's a type of account where the money that you put into it is tax deductible, right? And also the money that you pull out of it, and it has to be pulled out for medical purposes, like to pay for medical expenses or like medicines or whatever, right? When you pull money out for medical expenses, that also is tax free. You're not taxed on it, right? So it's tax-free going in and tax-free coming out, right? So it's really cool. And it grows tax-free, right? You can have an HSA that's invested and it will grow tax-free as well. So that's a really cool thing too. So these are some tips on how to legally, all of this is legal, how to legally minimize your income taxes. Now, number four, we're talking about multiplying your income. This is important. And as we talked about, one of the best ways to make money is by doing things that you love, right? You can churn. Remember, I mentioned, as my friend Michelle, often says, churn your passions into profits, right? And so I want you to think about what are some passions of yours that you can churn into profits? What are some hobbies that you can churn into businesses, right? So let's go through this. I'm going to take you through the steps of developing a business plan. Now, first, you want to identify what type of business do you want to open, what hobbies can you churn into a business, right? Now, next is create a business plan using one of those hobbies. And so when you're creating a business plan, and there's different types of ways to create a business plan, but here's one of them. I'm going to take you through 6 steps to creating a business plan, right? Number one is market analysis. You want to ask yourself, what is the problem that your business solves? Because really, entrepreneurs, business owners, it's all about solving problems, right? And actually, the bigger problem that we solve, the more money we earn in general, right? And the better ways in which we solve those problems, the more income we generate as well, in general. So market analysis is the first one, where you want to ask yourself, what is the problem that your business solves? Number two is competitive advantage. What makes your business unique? Number three, marketing. Who are your clients and how will you reach them? Number four, operations. What is the detailed technical process that you go through to bring value to your clients? Number five, pricing. What price do you charge? And what business expenses do you have? And what is your profit margin? And number six is finances. How do you keep track of the money that comes in and out of your business? Now, once you have a business idea and you have your business plan, right? Next thing that you want to really look at is understanding how to officially register your business. Now, regarding the business formation, the first question to consider is whether you should form an LLC, or if you only really need to register as a sole proprietor. Here's some background information on each. A sole proprietorship is an unincorporated business with one owner, and it's the simplest and least expensive type of business to form. An individual who operates a business on their own is by default a sole proprietor. The main characteristic of a sole proprietorship is that there's no legal separation between the business and the business owner. So the owner is personally responsible for the business's debts. Now, a single member LLC is a legally separate business entity that is created under state law. The defining feature of a single member LLC is that it offers the owner liability protection from the debts and obligations, like lawsuits, right, and stuff, of the business. In the normal course of business, a business creditor or someone who sues the business can't come after the personal assets of the owner. Now, here are some key things to consider when trying to figure out which type of business entity you should choose. Number one, ask yourself this: do you have personal assets that you need to protect? For example, if you are a young person who's just starting out as a new entrepreneur and you don't have a lot of personal assets, then you might not need to form an LLC right now. A sole proprietorship might be all that you need right now. Number two, does the nature of your business have a high risk of lawsuits? For example, if your business is a small online tutoring business, you might not need to form an LLC right now, right? A sole proprietorship might be all that you need for right now. Here is a general rule of thumb. If your business makes under $1,000 per month in profits, meaning your revenues minus your expenses equal less than $1,000, then you probably are fine with being just a sole proprietor. But when your business starts to make between $1,000 to $5,000 per month in profits, then you should probably become an LLC. And when your business starts to make over $5,000 per month in profits, then you should probably become an S Corp. So for the young people in my network, I have a lot of young adults that are in my network right now. So for most of the young adults in my network who have a small business that they want to register, I would encourage them to look into registering as a sole proprietor, and then later on they can consider transitioning into becoming an LLC after their business hits certain high levels of income, net income. Now, registering as a sole proprietor is super easy and costs very little. Now in Maryland, I'm in the state of Maryland. And so there are some differences from state to state. But in Maryland, the trade name registration is done through the website, the Business Express website. All right. And it's the state website, right? And in Maryland, it's called Business Express. The filing fee to register a trade name in Maryland is only $25, and it's valid for 5 years from the date of acceptance, and the renewal fee is also $25. All right, so $25 up front, and then $25 every 5 years just to maintain the trade name, right? Now, overview of the action plan. So number one, right, register as a sole proprietor. Number two, register as a DBA, meaning register your trade name, right? Number three, register to get your EIN number via the IRS website, right? Your EIN number comes from the website, right? Although when you register your business, that's through your states, right? But your EIN number will come from the IRS website. All right, now number four, open up a business checking account under your business name and business EIN, right? And research and compare business checking accounts, right? Number five, set up and maintain a simple bookkeeping system. Research and compare various bookkeeping systems and consider maybe starting small with just using a spreadsheet, right? Free option, right? Until you need to upgrade to a paid option like QuickBooks, right? Number six, set up and maintain a simple invoicing system. Research and compare various invoicing systems. Consider free options until you need to upgrade to a paid option. Number seven, monitor the growth of your business and be ready to transition from sole proprietor to LLC when the time is right. And number eight, determine if your business needs to pay estimated taxes. Now, number five is maximizing your credit score. This is very important because your personal credit score is a number that represents how reliable you are regarding paying back money that you borrow. The higher your score is, the more benefits you get regarding borrowing money, such as higher amounts that you can borrow, lower interest rates that you are charged for borrowing money, and many other benefits, such as lower insurance costs, right? You know that insurance companies often look at your credit score when determining what your premium is going to be, right? So you get lower insurance costs, right? More options for renting apartments. You know, a lot of landlords will check your credit score, right? More job opportunities, right? A lot of employers will check your credit score. Also, more opportunities to leverage good debt, right? There's a difference between good debt and bad debt, right? Bad debt's like consumer debt, but good debt is where it's like debt. It's where you are borrowing money so that you can earn more money, you know? So leveraging good debt, you have more opportunities to leverage good debt when you have a high credit score, right? Now, your credit score, it is based on your personal credit report, which is basically your personal financial report card that indicates how reliable you are to pay back debt based on your financial history. Now, there's different types of credit scores. One of the most popular types of credit scores is called the FICO score, right? It's used very often in mortgage lending, right? So your FICO score is made up of 5 factors, all right? Number one is payment history, right? Meaning, you know, how well have you been at paying on time, right? That's payment history. Number two is credit utilization. That's what percentage of credit are you using of the total amount of credit that is available to you, right? That's credit utilization, right? So you want to keep your credit usage low, right? Try to keep it lower than 30%. If possible, it's even better if you can kind of keep it under 10%, right? And even better if you can keep it under like 3%, right? So credit utilization, but definitely keep it under 30%, right? Next one is credit age, right? That's like how long, well, what's the average age of your credit accounts? Like, you know, how long on average have you been um, borrowing money, like how long have you had these accounts open, So which is why it's so important for 18-year-olds to get a credit card the moment that they turn 18, right? Because you want to start to build credit age, right? Of course, you got to be responsible with it though, right? Or else it's going to be counterproductive, But with responsible use, it's going to help you so much, right? Next one is new credit inquiries, right? So that's where it's like, how frequently are you applying for credits, right? So that can hurt you if you're applying too much for new credit accounts, right? And then the last one is credit mix, which is what types of credit accounts do you have, right? So there's something called installment loans where it's like a mortgage or a car loan where you're paying it back in installments. And then there's something else called revolving credit where it's like a credit card where you can charge and then you pay it off and then you can charge more, so that's revolving credit, right? So now, responsible use of credit is one of the most effective ways to build credits. If you do not qualify for a regular credit card, start by getting a secured credit card. And after several months of responsible use, you will be able to qualify for a regular credit card, right? This is a process that one of my nephews went through, and it worked well. Just after about 6 months of using a secured credit card, they offered him a unsecured credit card, a regular credit card. Now, monitor your credit report and score on a routine basis. The only website that is endorsed by the United States federal government to give you a free copy of your credit report, one from each of the three major credit bureaus, is this website here, annualcreditreport.com. You can go on annualcreditreport.com and print out a free copy of your credit report. Actually, like you can print out 3 free copies, right? One from each of the 3 major credit reporting bureaus, right? Equifax, Experian, and TransUnion. Now, keep in mind, it gives you this annualcreditreport.com. It gives you those free credit reports, but they do not give you a free credit score, right? But your credit score is based on your credit reports, right? Number 2, credit monitoring services, right? There's different credit monitoring services that you can take advantage of. There's CreditWise from Capital One. There's Experian free credit monitoring. There's Credit Karma. There's Credit Sesame. Now, keep in mind that there are 3 major personal credit reporting agencies: Experian, Equifax, and TransUnion. And there are many different types of scoring models, right? So there's something called a Vantage score, which is a little bit different than a FICO score, all right? But they should be all in the same ballpark in terms of their scores, right? Now, importance of monitoring your personal credit report and score. Very important to monitor it because, by monitoring it, you can identify ways to improve your score and strategize to prepare for future financial moves. Also, you can identify any errors, right? Also, you can identify fraud, right? Now, consider helping family members build their credit score by adding them as authorized users on one of your credit cards. Because that way, your credit card account and its payment history will also appear on their credit report, and that will help them piggyback on your good credit history and score. Now, note though, you want to check the minimum age requirements for authorized users because it varies among credit card companies. Also, make sure that you choose a credit card that reports authorized user status to all 3 of the major credit bureaus. That's important. So that is maximizing your credit score. Now, this little chart here kind of is a really cool graphic on the 5 different factors that make up your credit score, right? And so you see how not all of the factors are, weigh equally, right? The most important factor is your payment history. So, meaning the most important thing that influences your credit score is you paying your bills on time. That's what it is. You paying your bills on time is the most important thing that you can do to maximize your credit score. Make sure you pay your bills on time because your payment history makes up 35% of your FICO credit score. Now, 30% of your FICO credit score is influenced by your credit utilization, right? Your credit usage. So remember when I was saying how you want to keep it under 30%, but what's even better, keep it under 10%. And if possible, keep it under like 3%, right? You want to keep it low. Want to keep it low. You don't want to have it at zero though. All right. That's a very key point. You definitely want to be using credit because if you don't use credit at all, then they might go and close down the account, right? And it's actually a negative. It's going to work against you if you're not using any credit at all because your credit score is based on how well you are able to pay back money that you owe, and so you have to use credit, but just make sure that you're only using a very small percentage of the total amount of credit that is available to you. And so here's a little tip, right? To help you maintain a low credit usage percentage, every once in a while, ask your credit card companies for a credit limit increase because the higher your credit limit is, the easier it is for you to keep and maintain a low credit usage percentage, right? So that's a good little tip. Um, and then 15% of your FICO credit score is influenced by the length of your credit history, right? Credit age, right? The length of your credit history. That's why, again, I say you want to start, we need to teach our children to start early to develop credit, right? Right when they're 18, to have them open up a credit card, and make sure that they are using it, wisely, right? Make sure that they're paying the bills on time, right? And keeping the credit usage percentage low, right? So length of credit history is important. Credit age is important. 10% is based on the number of credit inquiries. So you want to be careful that you're not applying for too many credit accounts, especially if you're about to go through like a mortgage process, right? You don't want to be having a lot of inquiries on your credit report, right? All right, and then the final piece, the another 10% is based on credit mix, right? Which is like the mix of the types of credit that you have, right? So there's installment loans and then there's revolving credits, right? So that's what that is. Now, number 6, maneuvering your retirement planning. So there's different types of retirement accounts. One of the most powerful ones is this thing called a Roth IRA. All right. Now, let me back up a little bit and say this. Okay. So, do you know what an IRA is? An IRA. An IRA is an individual retirement account. There are several different types of IRAs. Two of the most well known types of IRAs are traditional IRAs and Roth IRAs. Now, what are traditional IRAs? So traditional IRAs is where the contributions, right, the money that you contribute into the accounts, right, the contributions are tax deductible, right, in the year that you contribute into the account is tax deductible, but the withdrawals from the accounts are taxable. So with a traditional IRA, you get a tax deduction for the amount of money that you put into your traditional IRA. You get a tax deduction in the current year. But when you reach retirement age and you start to pull money out of that traditional IRA, you're going to be fully taxed on that money. Okay. Now, so therefore, a traditional IRA works well if you are a person who's in a very high tax bracket, right? because you will be able to benefit from the tax deduction in the current year, right? But if you are a person that's in a low tax bracket right now, like if it's a relatively low tax bracket right now, then maybe you would want a Roth IRA because you wouldn't really want, because you wouldn't really need to have a tax deduction in the current year. You would benefit more by having a tax break in retirement, right? Because as we're going to talk about the Roth IRA, well, let's talk about the Roth IRA. In the Roth IRA, it's different than the traditional IRA. The Roth IRA, the contributions that you make into a Roth IRA, they are not tax deductible. You cannot deduct the money that you put into a Roth IRA in the current year. But when you reach retirement age and you're withdrawing money from a Roth IRA, all of that money is tax free. So although you don't get a tax deduction in the current year, the money inside of your IRA is going to grow tax free. And when you start to pull it out, it's all tax free as well, right? So I prefer Roth IRAs because although the contributions that you make to the account are not tax deductible, the account grows tax free. And there are several different types of investments that you could put into a Roth IRA. The type that I prefer is an index fund, right? Now, what is an index fund? An index fund is a portfolio of stocks or bonds designed to mimic the composition. Or let me repeat that. What is an index fund? An index fund is a portfolio of stocks or bonds designed to mimic the composition and performance of a financial market index. Now, what is a stock? Stock is all the shares by which ownership of a company is divided. A single share of stock means fractional ownership of the company in proportion to the total number of shares. And what is a bond? A bond is an agreement to lend money to a company or government for a certain amount of time at a fixed rate of return. Now, I prefer stock index funds instead of bond index funds because the returns are higher if your time horizon is long enough. So here's a simple rule, right? Never invest money into the stock market that you might need within the next 5 to 10 years, right? Because the stock market goes up and down, up and down. But over the long run, like at least 10 years, if you look at any 10-year period in the history of the stock market, it has always gone up in the long run. I mean, 10 plus years. But in the short term, it can take, a dip. It can take a very deep dip in the short term. But in the long term, it always goes up. So that's why I'm saying never invest money into the stock market that you might need in the short term. The money that you invest in the stock market should be for long term, right? Like 10 years or more, right? So let's talk about this. Now, a stock represents one single company, and the price of the stock is dependent on the performance of that one single company. That's risky. But a stock mutual fund represents a collection of multiple companies. And so the price of the stock mutual fund is not dependent on one company. Now, there are different types of stock mutual funds. The type I prefer are stock index funds because they simply invest in a specific list of stocks that pertain to a specific market index. And therefore, they are not actively managed by an investment manager. And therefore, the fees regarding stock index funds are lower than the fees regarding regular mutual funds. So now, how do you choose the right index fund? How do you choose the right index fund? Well, first, you got to do your research. Compare multiple index funds, look at these things in particular. Number one, look at what is the minimum investment amount needed in order to open the account. Okay. Some brokerages don't have any minimum at all. Like Fidelity doesn't have a minimum, you know. Also, number two, look at the expense ratio, right? So example, a 0.02% expense ratio means it's just $2 for every $10,000 invested. All right. So when you're looking at expense ratios, you're going to see different expense ratios. As a rule of thumb, any expense ratio that's under 0.05% is considered to be low. Okay. Anything above that, you got to be cautious, right? And this is important to look at these things because these expense ratios, they really add up over time. So you want to make sure that you are investing in something where the fees are very, very low, right? Number three, avoid transaction fees. Number four, look at the type of market index the fund tracks. The most popular index is the S&P 500 index. Now, how to invest in an index fund? How's it done? How to invest in an index fund? Well, number one, you open a brokerage account. Now, research and compare several brokerage companies and choose the one that you determine to be the best for you. Make sure you choose the brokerage company that is the original provider of the index fund that you plan to invest in. For example, if it is a Fidelity index fund that you plan to invest in, then choose Fidelity as your brokerage. If it's a Vanguard fund, then choose Vanguard as your brokerage, right? And in that way, you avoid unnecessary fees. Number two, invest through your brokerage account and consider setting up a Roth IRA account and a non-retirement account, right? Also, set up a monthly auto invest function, right? That way you don't have to manually invest money every month. It's just automatically. You want to set it up where automatically, right, money is invested from your bank account into your investment account, right? And you can set a portion, right? You know, and so you might say, okay, I want to do $100 a month or $200 a month or $500 a month, whatever can kind of fit into your budget, And look, here's the thing. Some people say, well, wait, should I wait until later on because money's tight? Well, look, get started. Even if you get started with $20 a month, right? A lot of these brokerage companies like Fidelity will allow you to auto invest at a super low, amount, right? A super low amount, like $20 a month. You can invest into your investment account, right? And that's important to get started early because even if it's a low amount, get started early to start investing because when you start investing, something psychological happens. It's like you begin to see yourself as an investor. And that brings even more of that investor mindset into your psyche. And so get started early to invest. In fact, it's so important to get started early because of the power of compound interest. So let's talk about interest. Interest is a very, very important concept, right? Because the concept of interest is the foundation of personal finance. Interest is the money you pay for borrowing money, and interest is the money you earn for lending money. Now, for example, let's say you invest $10,000 at an interest rate of 10% APR, right? Now, of course, in reality, the stock market goes up and down, and so your investment will fluctuate, right? But for the purpose of this example about interest, let's say that it was just a straight 10% annual, percentage rate every year. Okay, a straight 10%, right? Okay, so $10,000 at 10% APR that generates $1,000 for year one, right? And it generates $1,100 for year two. Then it generates $1,210 for year three, and then $1,331 for year 4, then $1,464.10 for year 5, and then $1,610.51 for year 6, and then $1,771.56 for year 7, and then $1,948.71 for year 8. Now, why is the amount of interest increasing each year? Why is that happening? It is because of the power of compound interest. So you see how compound interest works? You see how in the first year, you made 10% of the 10,000. That's why it was 1,000. But in the second year, you made 10% of the original 10,000, but also you made 10% of the accrued interest that had accrued so far. So you made 10%. So in the second year, you made 10% of the 10,000, but also you made 10% of the $1,000 that had accrued up until that point, right? And in the third year, you made 10% of the original 10,000, but also you made 10% of the accrued interest that had accrued up until that point. And then in the fifth year, in the sixth year, it keeps going. So do you see how the balance as you go from year to year, right? Because the interest is getting reinvested into the amount. So each year, the amount of interest that you're making is increasing because each year, the total amount of money, which is the original 10,000 plus the accrued interest, right? That total amount is increasing each year. And so that's why the interest keeps increasing. Another word, and so in other words, the interest keeps compounding. That's where we get the term compound interest, because you're making interest on not only the original amount, but you're making interest on the accrued interest that has accrued up until that point. The interest is compounding. And so, as you see in this example, in just 8 years, within 8 years, the account balance grew from $10,000 to $21,435.88. It more than doubled within just 8 years. So the key point is this. Key point is this. The earlier you start investing, the more you will benefit from the power of compound interest. In other words, the earlier you start investing, the faster you will build passive streams of income. And therefore, the faster your passive income will exceed your cost of living. And therefore, the faster you will arrive at financial freedom. This is so powerful, y'all. Let me give you another example. I want to encourage everyone to start investing immediately. Immediately. You can start investing today. Today, you can go on to a brokerage company like Fidelity and open up an account, or Charles Schwab or Vanguard, or anyone, T. Rowe Price, anyone. Do your research, open up an account, because compound interest is so powerful. It's the number one thing that creates millionaires. Compound interest, right? And so it's important to start early. Let me give you this example. This is going to blow your mind. This is going to blow your mind. So let's say that you start investing $200 per month. $200 per month. But that's $50 per week, right? $200 per month is like $50 per week, right? Now, some of you might say, well, no, I can't afford that. Wait a minute now. When you do your budget, when you do your spending plan, your budget, right? I'm sure that when you really look at the stuff that you're spending, you can find an extra $200. And even applying certain things like, have you called around and shopped around in terms of car insurance? I just recently went from paying $138 per month down to paying like $57 per month in car insurance, all because I started shopping around and I found a lower car insurance company. I switched to Geico, It happened to be Geico that was, lower. But you really have to search different companies, because and it's also specific to your situation. Now, see, I drive a car that's very old. I have like over like 165,000 miles on my car. It's like a 2012, so it's over, it's over 10 years old and then everything. And so, like in my situation, I don't need full coverage. I just need liability coverage, And so, depending on your situation, right? You can shop around and find, you might be able to find lower car insurance than what you're paying right now, maybe, especially if you haven't shopped around recently, So I bring that up just as an example to say, when you really look at your finances, I believe that you'll be able to find at least an extra $200 that you can be saving and investing, So here's this example. Suppose a 25 years old, starts investing $200 per month into an average, typical Roth IRA stock index fund, right? Which historically averages around 10% in interest every year, right? Average interest rate of a stock index fund is around 10%. So using that number, $200 per month, by the time, and if you start at the age of 25, then by the time you reach 65, that amount will be over $1 million, like 1.2 million, 1,264,815 and $815, right? Over $1 million in that one account, just by starting at the age of 25 and investing just $200 every month. Now, if you wait though, and until you're 35 to get started, right? So you wait 10 years, you start at 35, you do $200 per month. That amount at 65 is much lower. It would be $452,097. So almost, what is that? 5, 6, like over $700,000 less just by waiting 10 years, right? If you wait until you're 45 to start investing $200 per month, at the age of 65, that amount will be 151,873, right? That's over $1 million less than a person who started at the age of 25, right? If you wait until you're 55 to get started, then that amount at 65 would be $40,968. So do you see what this is showing us here? The earlier you start investing, the more you're able to take advantage of the power of compound interest. Start early. Start early. Now, number 7 is maintain healthy boundaries. Very important to have a good morning routine. The first 2 hours of your day sets the tone for the whole day. So I encourage you to go to bed early enough so that you can wake up early enough to devote the first 2 hours for your self-care. Focus on filling your cup and putting on your armor, because that way you will build the momentum and energy and stamina to deal with the distractions, discouragements, and disappointments that come with each day. So I want you to think about, what is your ideal morning routine? Now, I know some people are in certain situations where maybe they can't get to bed early because maybe you have certain responsibilities, right? You might have a child that you are, caring for, whatever, right? You might have certain responsibilities. So, I get it. And so here's the thing. I mean, my main point is this, all right? Make sure that at some point during the day, you have some time to have some self-care time, you know? Make sure that you have healthy boundaries. Make sure that you have some time. If it's not I prefer it to be in the morning, but if you can't do it in the morning, maybe you could do it at night, or maybe you could do it in the middle of the day or whenever. But make sure you have some self-care time to really fill your cup. Because by and it's not selfish. It's not selfish. Having self-care time is not selfish, because having time for yourself, it helps you to be able to pour into others. being able to have time to really fill yourself up, it puts you into the position to effectively pour into others. And now I'd like to ask you for your feedback. Your feedback. 3 questions. Please be totally honest because your feedback is so important. So important. Number 1 is, what were the key messages you learned from this seminar? Right? What were the key messages that you learned from this seminar? Number 2, what did you like the most about this seminar? What did you like the most about the seminar? And number 3 is, how was this seminar useful to you? All right. So, in other words, as a result of this seminar, what specific action items do you plan to take? And when do you plan to take those actions? And who will be your accountability partner? Accountability is important, y'all. Very important. Like, I have a private Facebook group that I created to set up accountability in terms of personal finance, you know? And so please connect with me on Facebook by searching Lance Clay Smile Smith. Send me a Facebook friend request. Also send me a message and I'll send you an invite into my private Facebook group. And let's keep in touch. You can find me on Facebook, Instagram, and LinkedIn at Clay Smile, although I'm most active on Facebook. I don't really, currently, I don't really check Instagram and LinkedIn much, but I plan to get better at getting more involved in those platforms. But for right now, I'm mostly active on Facebook. All right. Thank you for watching, and I'll see you next time on the next video.